A storm in the making. Imagine this. Pause. Every second person you meet is talking about stocks. Your neighbor, your cousin, even the guy at your coffee shop. And emphasize that everyone's in. Everyone wants a piece of the market. Sounds exciting, right? Like prosperity for all. And pause, but here's the catch. Economists are alarmed. Record high stock ownership, more people than ever holding shares, isn't always a sign of strength. In fact, it might be the flashing red light on the dashboard. And pause. Why? Because when too many people are riding the same train, the risk of a derailment skyrockets. If markets stumble, millions of people, not just the wealthy, are exposed. Ordinary households, retirees, young investors putting in their first paycheck. Her pause, lower tone, and when fear spreads, panic selling can turn a dip into a disaster. It's like everyone's standing on a crowded bridge. The more people pile on, the weaker the structure becomes. One small crack and suddenly collapse. I emphasize that's the danger of record high stock ownership. In this video, we'll break it down step by step. Worried. What history teaches us. The red flags flashing right now, and most importantly, what you can do to protect yourself. So buckle in. This isn't fear mongering. It's financial reality. And the sooner we understand it, the better prepared we'll be. And pause. Why everyone owns stocks now? Let's rewind a bit. And pause. How did we even get here? The rise in stock ownership didn't just happen overnight. It's the result of decades of shifts in money culture, technology, and policy. First, low interest rates. For years, banks offered close to nothing on savings. I emphasize that people had to look elsewhere for returns. And where did they go? The stock market. Second, apps and accessibility. Platforms like Robinhood, eToro, and others turned investing into something you could do on your lunch break. No broker suits. No complicated paperwork. Just a swipe, a tap, and boom. Third, social influence. We can't ignore it. TikTok, YouTube, red threads like Wall Street bets, they made stock trading cool. Even a bit rebellious. Suddenly, investing wasn't just for Wall Street guys in suits. It was for everyone. And finally, pandemic stimulus checks. Remember, there's millions of people stuck at home with extra cash. Where did a huge chunk go? Straight into the market. Pause. On the surface, all of this looks like democratization, power to the people, average folks finally building wealth. Han emphasize, and yes, there are positives. But here's where economists raise the red flag. When the market becomes the place for everyone's money, it also becomes the single point of failure. And pause. One downturn doesn't just hurt a few, it ripples across society. So while record ownership looks like progress, it may also set the stage for the next big crash. Lessons from history. History is the best teacher. Her pause. And when it comes to financial markets, it often teaches the same painful lesson. What goes up must come down. Let's go back to the late 1920s, the roaring 20s. Everyone was investing. Taxi drivers, teachers, housewives. Stocks were the talk of the town. The 1929, the Great Depression. The crash wiped out life savings, businesses, and dreams. Fast forward, pause, the dot-com bubble in the late 90s. Internet stocks with the new gold rush. Everyone wanted in, shares skyrocketed, and then, boom, billions lost when the bubble burst. More recently, 2008, housing wasn't stocks, but the lesson's the same. When too many people are tied to one financial asset, collapse spreads like wildfire. He emphasizes you see the pattern. Whenever ownership becomes too common, risk magnifies. Crowds push prices higher, often beyond what's reasonable. And when reality hits, when earnings disappoint or rates change or global shocks arrive, the fall is harder, deeper, and faster. Economists fear we're at a similar tipping point today. With record participation, corrections don't just bruise a few wealthy investors. They shake the entire foundation of society's wealth. Pause, think about your retirement, your savings, your neighbor's mortgage. A crash doesn't stay on Wall Street. It hits Main Street. And that's why this moment feels eerily familiar to historians of finance. The red flags today. So what's happening right now that has experts sounding alarms? Our pause. First, valuations. Stocks are trading at historically high price to earnings ratios. Translation. People are paying more than ever for each dollar a company actually earns. That's often a bubble signal. Second, concentration. The majority of market growth comes from a handful of tech giants. Apple, Microsoft. Amazon's like balancing a table on just one leg. If it wobbles, the whole thing tips. Third, debt levels. Investors aren't just using their own money. Margin debt, borrowing to invest. Emphasize if markets slide, forced selling accelerates fall. Fourth, economic headwinds. Inflation pressures, interest rate hikes, global instability. These aren't small background noises. They're storm clouds. And finally, sentiment. The everyday investor is extremely confident. Too confident. And pause. Lower tone history shows that when everyone believes markets only go up, that's usually the peak. Economists don't point to one single trigger. It's the mix. The cocktail. Overvaluation, concentration, debt, and overconfidence. Together, they create what's known as systemic risk. Pause. In plain words, the bigger the crowd at the party, the harder the stampede when panic starts. What this means for you, here's the real question, and pause. What does all this mean for you, the everyday investor, saver, or future retiree? First, don't panic. Fear makes people reckless. Selling everything at the first sign of trouble often locks in losses. Second, diversify. Economists repeat this for a reason. If all your money sits in stocks, you're exposed. But if you spread across bonds, real estate, cash reserves, even alternative assets, you lower risk. Third, know your time horizon. If you need money next year, don't gamble it in high-risk stocks. But if your horizon is 20 years, short-term dips already matters. Fourth, watch the signals. If debt is rising, inflation climbing, or rates tightening, tighten your own belt too. Reduce risk exposure before the crowd panics. And finally, educate yourself. Knowledge is your strongest shield. Most people lose money in crashes not because of bad investments, but because of bad reactions. The truth is, you don't need to predict the crash. You just need to prepare for the possibility. Here, pause, slower tone. Remember, crashes come and go. Markets fall. They rise again. But those who plan, those who balance optimism with caution, are the ones who survive and thrive. Closing and call to action. So, where does this leave us? The pause record, high-tech ownership is a double-edged sword. On one side, it's proof that finance is no longer just for the elite. Everyday people have access like never before. That's progress. But on the other side, it raises risks. Economists are right to worry. Because when everyone's tied to the same asset, one stumble can trigger a chain reaction. The lesson, pause, don't be scared. Be smart. Be prepared. Learn from history, diversify, keep perspective. And remember, markets are not the enemy, they're tools. Tools that can build wealth or destroy it, depending on how wisely we use them. But emphasize your financial future is not just about what the markets do, it's about what you do. So take control, build knowledge, take small steps today that protect you tomorrow. Hey, pause, warmer tone, because here's the truth, wealth isn't built in moments of hype. It's built in moments of patience, discipline, and preparation. And if you found this video helpful, subscribe for more insights, tips, and strategies to stay ahead of the curve. Hank Smile and Ton, remember, small steps today create big wins tomorrow.